Hello everyone, my name is Han Nguyen. Welcome to my presentation on cost volume profit analysis for the MBA 840 Managerial Accounting class. In this presentation, I would like to explain the concept of cost volume analysis. It's also called CVP analysis. Cost volume profit analysis is a systematic method that examines the relationship among selling price, sale and production volume, costs, and profits. By comparing the relationship among the cost of operating and making products, the number of products sold, and profit generated from the sale of the products, CVP analysis gives a company a strong insight into their net profit. Cost volume profit analysis is a powerful tool in managerial decision making. It enables business to figure out how changes in fixed costs, variable costs, selling price, and volume affect the company profit. To determine the level of output of products sold required to break even. To forecast the level of sale required to maintain a given amount of profit at different level of price. It also enables the business to establish what will happen to the profit if specified volume fluctuates. The most critical part of CVP analysis is the break-even point. It is the point where the total revenue equals the total cost. At this point, the business operating income is zero. There is no profit or loss incurred at this point. The break-even point defines when the business makes profits. If sale above break-even point, the business generates profit, and sale below break-even point result in a loss. The break-even point can be calculated using equation method or contribution margin method. The formula used in each method are listed on the slide. I will go into more details later in the application portion. And what I mean by contribution margin is the amount remaining from sales revenue after variable expense had been deducted. Is it the amount remaining to cover the fixed costs? After the fixed cost is covered, any remaining contribution margin is counted toward the net operating incomes. Cost volume profits graph is a helpful tool that assists managers understand more deeply about the relationship among cost, volume, and profits or loss. The graph shows sale, cost, and the related profit or loss for various levels of units sold. In CVP analysis, we assume total cost and total revenue behave in linear fashion, so we only need 2 points to plot each line. To create the cost volume profit graph, first we will plot the total revenue by picking any 2 points. One convenient point is the origin of the graph where the revenue is zero at 0 units sold. Second point can be chosen at any other convenient unit sold and determine the corresponding total revenue. In this case, I pick point where 500,000 units sold and the revenue at the selling point is $5 million. Second, plot the total fixed cost. In this case, the fixed cost is given at $1.8 million. Next, we'll plot the total cost line. Just a reminder that the total cost is the sum of total fixed costs and the total variable costs, and the fixed costs remain constant even though the company had not sold any product yet. So the first point of the total cost line is where 0 products sold and the cost is $1.8 million. It's also the lowest point of the total cost line. Then we can select a second point by choosing any other convenient number of units sold and determine the corresponding total cost. In this example, I chose the second point at 500,000 units sold and its total cost is $3.8 million. The last step is to determine the break-even point. From previous slide, we know that the break-even point is where total cost equal total revenue. So on the CVP graph, the break-even point is the intersection of the total cost line and the total revenue line. Any units sold below break-even point indicate loss, which is labeled on the graph at the lower left corner, and any units sold above break-even point indicate profits, and is labeled on the upper right corner of the graph. The next important concept in CVP analysis is target net income. Target net income is the amount of the net operating income or profit the company desires to achieve at a certain period of time. The target net income helps the management answer how many units the company must sell to achieve the target profit. Similar to break-even point calculation, mathematical equation and contribution margin can be used to determine the sale volume needed to achieve a target profit. And the equation used in each method are listed in the slide. The last important concept I want to touch on is the margin of safety. In cost volume profit analysis, margin of safety refers to the excess of actual sale over break-even sales. It may be calculated at the difference between actual sales and the break-even sales. Margin of safety can be expressed in dollar or percentage. Margin of safety is a useful tool to help management understand how far the sale could be changed before the company would experience a net loss. The last portion of my presentation is the application and interpretation of cost volume profit analysis. Here we have Innova Inc. manufacture nail polish. The company projected sale for the next year will be 500,000 units. The selling price for each unit is $10. Total variable cost per unit is $4. The total fixed cost for the years is $1.8 million. 1. Calculate break-even point in unit using contribution margin approach. 2. Using contribution margin method, calculate how many units the company must sell to achieve this target net income of $6 million before tax earning. And 3. Calculate margin of safety. First, we will calculate the break-even point in unit. We will need to figure out the contribution margin per unit. We have sale unit is $10, subtracted by the variable cost $4 per unit. It gave us the contribution margin per unit is $6. The second step is using the break-even equation to calculate the number of units the company needs to sell to break even. Substituting the value into the equation of step 2, we would get x equal 300,000 units. So what does this number tell us? It means that the company must sell 300,000 nail polish bottles to break even. For the quantity sold fewer than 300,000 units, the total cost exceeds the total revenue, and it indicates that the company lost. Any quantity sold above 300,000 units, the company generating profits. The second question asking us to calculate how many units the company must sell to achieve the target net income of $6 million before tax earning. Here we use the contribution margin approach to calculate the required sales. We have total fixed cost is $1.8 million. Target net income is $6 million, and the contribution margin per unit that is calculated from question 1 is $6. Plugging in the numbers, we have the required sales is 1.3 million units. This number tells us that if the company wants to generate $6 million before tax earning, they must sell 1.3 million nail polishes to achieve the target net income. And the last question asking us to calculate the margin of safety. It can be simply calculated at the difference between actual sale and the break-even sales. And in this case, we need to calculate the contribution margin ratio and the break-even point first. After getting those numbers, we can simply plug in the equation in step number 3, and it will give us the margin of safety equal $2 million. And this number tells us that the company's sales dollar are expected to be 2 million higher above the break-even point before the company experienced a net loss. And that's it, the end of my presentation. Thank you for listening.